Just finished adjusting journal entries? Great job! But here's a pro move. Reverse them. Yep, reversing journal entries help keep your books clean and simple next period. In this video, I'll explain what reversing entries are, when to use them, and show you exactly how they work using lemonade stand examples. Let's go! Reversing journal entries are optional entries made at the beginning of the next accounting period. They basically undo some adjusting entries you made at the end of the last period. Why? Because it helps prevent double counting and makes it easier to record new transactions. Think of it like hitting the reset button on certain accruals. Why do we use reversing entries? Let's say your lemonade stand owed your cousin $200 for helping in June. You recorded a wage expense and a liability. When you actually pay her in July, if you don't reverse that entry, your system might think you paid twice. Reversing fixes this by zeroing out the prior adjustment so you can record the actual transaction without confusion. Now let's take a look at the 5 types of reversing entries using a lemonade stand business. First, let's start with accrued wages reversal. At the end of June, your lemonade stand owed your cousin $200 for working a few hot afternoons, but you hadn't paid her yet. So you made an adjusting entry to show the wages owed. On July 1st, you make a reversing entry to cancel that out. This way, when you actually pay her later in July, you can record the payment like a normal transaction without doubling the expense. Easy and clean. Next, we take a look at accrued revenue reversal. Imagine you delivered a bulk lemonade order to a local event on June 30th, worth $150, but the customer said they'll pay in early July. You still have to show the revenue for June, so you record it using accounts receivable. But once July starts, you reverse that entry. This clears the books, so when the cash comes in, you simply record it like normal. Cash in, revenue earned, without inflating your income. Next, we take a look at unearned revenue reversal. A customer prepaid $120 in June for a month-long lemonade subscription. You earned $60 of that by June 30th. To reflect the revenue earned, you adjust your books. On July 1st, you reverse the entry to reset your revenue and liability accounts. That way, you can recognize July's revenue cleanly without confusion or double booking. Next, we take a look at interest payable reversal. Let's say you borrowed money to upgrade your lemonade stand and owe $40 interest for June, which you haven't paid yet. You record that interest expense and payable at month end. Then, on July 1st, you reverse the entry. This makes room to record the actual payment in July without mistakenly recording the interest twice. Not every adjusting entry gets reversed. For example, prepaid expenses like insurance or rent are gradually used up over time. These are not reversed because they don't involve payables or receivables that would confuse future cash payments or receipts. In short, if the adjusting entry doesn't impact cash flow timing or create a short-term liability or asset that will reverse itself, you usually leave it alone. Here is a quick recap of what we have discussed in this video. To wrap up, always remember to reverse non-cash accrual entries at the start of a new accounting period before any related transactions occur to simplify future cash-related bookkeeping. That's reversing journal entries made simple. If this helped you, hit that like button and don't forget to subscribe to Accounting Journal Entries.